Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, July 17th, and you are tuned into On Trend, the show designed to keep you on the right side of the trend. So today we're going to look at the high-low indicators. We're going to see that for the broader market, new highs are still dragging, and that's why the S&P seems to be just laboring higher. We look within, we look at the sectors, we can see leadership coming from tech, staples, and healthcare. Then we'll look at the materials SPDR because its top component looks very weak and prone to a potential breakdown. We'll then turn to energy with the energy SPDR forming a bull pattern and XES battling its breakout. I'll show you where to find earnings dates because we are we're starting earnings season. We've already had some reports from big banks last week, and we got a bunch more reports coming up. And then we'll do stocks to watch. We've got the big banks, big healthcare stocks, and more. So index new highs still dragging. So this first chart here shows the high-low indicators for the S&P 500, the S&P mid-cap 400, and below the S&P small-cap 600. And we'll just do the top two first. And the first chart there at the top shows the S&P 500 equal weight index, and it's in a rough uptrend there. You can see we had the big hit in February, but we've been moving higher over the last, since February basically. Now, if we look at highs and lows for the S&P 500, we had plenty of new highs going from that September to January period, especially January here, when we had just a ton of new highs. And then we got some new lows with the February decline and some new highs with the March bounce. And then, highs and lows kind of, equaled out, but new highs still had the edge. And then we had another spurt there in June. And it was like, okay, maybe the correction is ending because we had also a breakout there from a triangle. But then we got, a dip in new highs again. And you can see now new highs still can't get above 50. Now, the horizontal lines on each of these are marked at the 10% level. So 50 for the S&P 500, 40 for the S&P mid-cap 400. And then the lower line would be minus 50. And basically, the trouble starts when we see new lows get below that minus 50 area like we almost did in February. And then you can see mid-caps got below that minus 40 area there in February. Now I'm going to scroll down so we can see all three on one chart. All right, so here we have the S&P 500, S&P mid-cap 400, and S&P small-cap 600 highs and lows. And you can see that mid-caps performed quite well in that late May, June period with the high-low indicator getting above 40, which is 10% of the S&P mid-cap 400. And you can see the line here for the S&P small cap 600 is at 60, which is 10% of the S&P small cap 600. So you can see we had a lot of moves above that 60 level in May, June, and even one there in July. So that's where the leadership is coming from. It's coming from small caps, and that's nothing new. And I think the reason the S&P 500 is struggling is because you can see we haven't been above that 50 level since the middle of June, the early middle part of June. And even when we were above it here, we barely got above and then moved back down. So there's not a lot of leadership in the S&P 500 and for that matter in the S&P mid-cap 400. But as I'll show in this next chart, there's more leadership than there is, say, downside pressure, and the balance is still bullish. This chart, I've got the S&P 500 in the top with the green line being the 50-day EMA, red line the 200-day EMA, and you can see the 50 days above the 200-day. Price is well above the 200-day, so clearly a long-term uptrend working there. And then we've got the cumulative high-low lines for the S&P 1500 first, and you can see that that's the black line there, and then the pink line is a 10-day EMA, and we moved above on April 5th. So that's when new highs were basically outpacing new lows. And, even though we didn't have that many new highs overall, we still had more new highs than new lows. And that's what kept that line above its 10-day EMA since April. And that's kind of defined the uptrend that we're currently in. And you can see the S&P 1500 is still above. And so that for me tells me the bull market is just fine right now. Now, if we scroll down, we can break down these or break down the S&P 1500 into the S&P 500, 400, and S&P 600. So here you can see that the high-low line for the S&P 500 moved above its 10-day EMA on May 7th. And then on April 5th, the high-low line for the S&P Mid-Cap 400 moved above its 10-day EMA. And then on March 5th, the S&P Small Cap 600 high-low line moved above its 10-day EMA. So small caps were first, mid caps were second, and large caps were third. And they've all been in sync since early May. And you can see now that all three are still above their 10-day EMAs. And I would not become concerned with a correction in the market until we started seeing these high-low lines move below their 10-day EMAs. All right, now I'm going to take the high-low concepts that we just showed and apply them to the sectors to see that we have leadership in healthcare, technology, and consumer staples. All right, on this chart, I've got high-low percent indicators. This is new highs minus new lows divided by total issues. And you can see it is the histogram here. We got the S&P 500. The red line there is the 20-day EMA of the high-low percent indicator. So you can see it was strong positive there in January. And it's been just hovering above zero for most of 2018 here since that dip below zero in April and then back above in May. And we've basically been hovering above zero for the last few months. Now I've got the sector high-low percent indicators below that, and they are sorted by the 20-day EMA of high-low percent. So you can see technology on the left there, the 20-day EMA is at 8.13%. So it is the highest of the high-low percent indicators. That tells you that this sector has the most new highs. This sector has the most upside leadership. And then kind of a surprise, we have consumer staples at 6.81%. And you had a lot of new lows in consumer staples there in March, April, May, and even into early June. But then new highs started perking up there in the latter part of June and into July. So consumer staples has turned into one of the leaders. Now, if we scroll down, we'll look at the next group, and we can see healthcare coming in there. And what's interesting about healthcare is it was kind of dogging it there in February, March, April, May, and then started picking up in June and also picking up here in July. So I think this is one of the stronger sectors. So those are my top three. And then it kind of narrows a little bit. You can see energy, the EMA is at 4.29%. So that means that averages 4.29% of stocks in XLE are hitting 52-week highs. And, you know, the average was much higher there in April, May, and then it moved down as you got into that 4-week average towards the end of June there. You can see it moving down, and it's flat. But there are a few new highs perking up in energy, so that's one possibly to watch. And utilities, yeah, I'm not sure what to think about utilities, kind of up and down, up and down. And then if we look at the bottom half here, we can see we're going to get consumer discretionary, industrials, materials, and finance. So consumer discretionary had that burst of new highs in June, a lot of retailers hitting new highs, and then kind of fell back. So yeah, it's still net bullish, as I'm going to show a little bit on. Industrials, yeah, I think new highs have a slight edge, but not by much, because you can see some new lows creeping in there over the last few months, so it's not that strong. And materials is kind of, yeah, neither, it's hit and miss, you know, a few new highs, a few new lows, nothing really strong happening there. And then when we get down to the finance sector, we can see that it is the weakest. So you can see we had some new highs at the end of the year and beginning of January, and a few in late February, March, and then a few in May and June. But then, you know, new lows crept in and not very many new highs now. But as I'm going to show, some of the big banks are possibly in corrective patterns and could be moving out of these corrections. That'll be towards the end of the presentation. All right, now I've got the high-low lines for the S&P 500 and the 9 sector SPDRs. We don't have real estate yet, but maybe that's going to be coming. We don't have that XLRE high-low percent indicator yet. And I've got a 20-day EMA because when I use sectors, I usually make a bigger, a longer period EMA than with a broad index. And we can see, first of all, that all 9 are above their 20-day EMAs. All right, so that tells you that these sector weights are clearly bullish because all 9 of these high-low lines are rising still. Some are rising less than others. You can see technology's got a strong rise to it, and it's been, well, you can see it's been above its 20-day EMA the entire year. There's the beginning of 2018. But we look at finance, you can see that it's kind of struggled over the last few months as that high-low line is flattened, and it even dipped below the 20-day EMA, but is yet to really turn down, so we'll be watching that, and that's part of the reason the finance sector is lagging. Now, if we scroll down, we'll see consumer discretionary, industrials, and healthcare. We can focus on those. So we can see the XLY high-low line, no problem. It's flattening, but it's above its 20-day EMA. We can see some weakening in the industrials high-low line, but it has turned back up and is above its 20-day EMA. The healthcare high-low line turned up there in the middle of March and remains well above its 20-day EMA. So this is one of the strongest sectors as far as the ability to produce new 52-week highs. And if we scroll down, we can see the last 3, that would be, or last 4, staples, energy, and materials. We can see staples turning up there in June and making a big move up, so that's positive. Energy remains positive even though that high-low line is flattened. We can see materials had some weakness there in May, turned up in June, but is pretty flat. This is probably one of the weaker high-low lines. And finally, we can see utilities had an upturn in June and remains well above its 20-day EMA. But the bottom line is all 9 sectors, their high-low lines are above their 20-day EMAs. That's net bullish for the broader market. Materials, finance, and industrials are the ones to watch because they could be making a move up or down soon. The materials SPDR, and in particular its top component, look weak, and we'll see how that might play out. All right, as many long-term readers know, I am a big fan of knowing the components of your sector SPDRs or your ETFs that are dominated by a few stocks. You have the SPDRs like XES, Oil and Gas Equipment and Services SPDR, or the Retail SPDR XRT. Those you don't need to know because they're very broad ETFs with relatively equal weights. But when you get to the sector SPDRs, they are weighted largely by market cap. And that means the largest stocks are going to dominate. And if you look at the top holdings here, you can see that Dow DuPont is 22.6%. Clearly the dominant there at almost a quarter of the ETF. Now it may seem ridiculous, but it is what it is. There's the dominant player in the materials sector. Now when I look at this chart here, I saw a falling wedge and it looked like we were getting a breakout there. And we had higher highs and it was looking bullish. But all of a sudden, we had this sharp decline, and we had a bounce that's failing already. So it looks like this one is vulnerable, and if we get a close below 57.5 there, that is going to be a bearish development for the materials sector. And if you want to know where this one's going, of course, you have to look at Dow DuPont. Now, before we do that, I want to show you another way to look at the materials sector. There are 3 materials sector ETFs that I follow. First, there's the equal weight materials ETF, RTM. So it weights Dow DuPont just like any other stock in the ETF. And you can see it's not strong either. There you can see that wedge and that break below the low from May. So it is looking vulnerable to further weakness. Now, the small cap materials ETF is stronger. It broke out of a triangle consolidation there in May, June, and is holding above support, but a break below 52 would be negative there. And then, of course, you have the materials SPDR here, which a break below 57.5 there would be bearish. You might call it 57 for a little buffer, but 57.5 looks like the low from May or from June, July. Here's the chart for Dow DuPont, and I've got a couple of indicators there. The pink shading there is the price channel. It's a 255-day price channel, and that basically means it's the 255-day high, and then down here you can see the 255-day low. So you can see that Dow DuPont was making 52-week highs there in January, came down, did not make a 52-week low yet, but it gives you an idea of where the 52-week high and low are when you put on the price channels. Now the concern here is you have this big decline, and then we have the zigzag advance. And you can see we've come up to retrace around 61.8% of that advance, and we've come down to support, and we've kind of consolidated. And if we break support here, I think that is going to be a bearish development. And if you look here at the PPO 50-200 0, you can see that it has been below zero for most of the last 2 months. That means the 50-day EMA is below the 200-day EMA. So Dow DuPont is not looking like a winner right now. Now we're going to turn to energy with a big bullish continuation pattern possible in XLE and a support battle with XES. This chart here shows XLE, and it's an interesting pattern because you had this massive advance there from 60 to 78, over 20%, a very sharp decline. Then you firmed for a couple of months and had the big breakout. We came back up to resistance. Actually, we exceeded that high, but then we kind of consolidated. So overall, this could be a big cup with handle pattern, and a breakout at 79 would be bullish. And if you just take the right side of the pattern, it's basically a sharp advance and a consolidation here, and a breakout at 79 argues for a continuation higher. Now on the downside, the negative is that oil took a hit over the last week and a half or so, and if that continues, that could weigh on energy. And if you get a break below 73, that would be negative for this sector. Again, with the holdings, if you look over to the left, you can see ExxonMobil, 22.9%, the biggest stock clearly. But Chevron is not too far behind at 16.4%. And then you have a big drop off to Schlumberger at 6.52%. But there you can see the top two account for almost 40% of the ETF. So you better be watching those two. Here is the Oil and Gas Equipment and Services SPDR, and you can see there are the holdings on the left-hand side, and they're fairly equally weighted. See, Schlumberger is 3.53%. It's not even the top holding. It's fairly equally weighted. So you really don't need to know the holdings in this ETF. You just need to know what kind of stocks are in it. But we can see some kind of maybe a very choppy uptrend. And we had a pretty sharp downswing there in April or May and June. And we found support near broken resistance and that 61.8% retracement. And then we got the bounce. And what I think is a breakout here well, that would be last week with the breakout there around 17 and change. We fell back after the breakout, but I wouldn't call it negated unless we go below 16. And you can also see, look at RSI, man, it just works wonders. It moved below 30 to become oversold right there around 16, and that kind of marked the bottom. Now I've got 10-period RSI here. When I use the SPY or QQQ or IJR, I use 5-period RSI because they're broader and they tend to move a little less volatile. And then when I move to industry group ETFs and stocks, I tend to use 10-period RSI. I suggest you put them both on the charts, see how they compare, and see which ones you like. You'll find that RSI 5 is going to move below 30 a lot more than RSI 10, and especially RSI 14. So if you want more signals, use RSI 5. If you want fewer signals, use RSI 10. Now this chart here shows ExxonMobil, which was the biggest component in XLE. And you know, this is just kind of crazy here. There you can see the price channels there, the 255-day price channel. So this is basically a 52-week high there in January. And then a few months later, a 52-week low. I mean, come on, make up your mind here. So this one, you know, it's not the dull buy and hold stock it used to once be, maybe, because you can see it moving from 73 to 87, back to 72, and now back up to the low mid 80s. But there's an uptrend working here for ExxonMobil, and you got a clear support zone there around 79 79.80. So I would keep a bullish bias as long as 79.80 holds. And there you can see the PPO 50-200-0. That's the 50-day EMA above the 200-day EMA. Yeah, it's gotten a lot of whipsaws like here in February, and not such a whipsaw there in October. But that's what moving averages do when you have a trading range. They whipsaw. But the bottom line is, as long as ExxonMobil holds above 79.80, that should be a net positive for XLE. So earnings season kicked off last week, and we're going to get a lot of earnings going forward. If that interests you, I'm just going to show you a few places I find earnings and also where you can find the component stocks for ETFs. If you're looking for the earnings date for a particular stock, you can use Zacks. You can enter the symbol up at the top right, or once you've entered a symbol, you can also enter it there in the middle. And there is the earnings expected date for Zacks on August 16th. It would be for Ross Stores. So IBD is another site to consider for earnings. You can enter the ticker up there at the top right. I've entered Analog Devices to get a quote. And then if you scroll down to the lower part, you're going to get the company fundamentals part. And there you can see at the top, there is the earnings date that they're expecting. If you're looking for holdings, all I do is Google the term. If I'm looking for the materials, SPDR holdings, XLB, SPDR, and holdings, I skip all of the other sites except for the family website. There's the sector SPDR website, and there is the US SPDR's website. Go directly to the source. And before we get into the individual stock setups, if you have any questions or comments or feedback, you can always send an email to askarthur@stockcharts.com. I cannot answer all of them, but I promise to read them. And keep your questions to the chart, please. Something to do with technical analysis. Keep the fundamentals, the Fed, China, whatever. Keep that out because all I'm looking at is the chart and the technicals. Now, the next section is going to be stocks to watch, of course. We've got big banks, we've got some healthcare stocks, and more. All right, we'll start off with the finance sector because it had a big move yesterday, or a number of stocks did as well in the finance sector, and the finance sector was up last week. And I've got a weekly chart here to get some perspective on what's going on. But look at this, from February 2016 all the way until January 2018, we have basically an 88.8% advance, a massive, massive advance. And now we've had a long sideways correction. And I say sideways, well, it's slightly falling and it looks like a falling wedge. And there you can see the red line is the 40-week EMA, or the 40-week simple moving average. And we're just now trying to move above it and break above that wedge line. And that could be positive for finance. Now, if I look at the top components, I've got Berkshire and JP Morgan. And you can see Berkshire is going to report on August 3rd. JP Morgan has already reported, so that's out of the way. But what's interesting is JP Morgan's correcting, and look at that surge yesterday. It's breaking above the 40-week moving average and above that wedge line. So that could signal a continuation of the bigger advance and be bullish for this sector. Now, if we scroll down, we can see Bank of America, Wells Fargo, and Citigroup coming in. Now, Bank of America has a similar pattern as XLF, and you had that new high, and then you have the wedge correction. But look at Bank of America. They reported yesterday, so this is out of the way, and now above the 40-week moving average and turning up. This 40-week moving average is almost equivalent to a 200-day moving average. Wells Fargo, they've already reported as well. But what's interesting about Wells Fargo is they were advancing when the others were declining. You see, Bank of America was declining. Well, this one was advancing. Of course, it got hit with a scandal and stuff there in January, February, and March. But it's rebounding pretty good and could be ready to challenge these highs. Citigroup has already reported as well. They're not above the 40-week moving average, so I'd say they're weaker than JP Morgan and Bank of America. Bank of America and JP Morgan would be choices ahead of Citigroup. Now moving down, we've got Goldman Sachs, which reports tomorrow. And you can see on the chart that Goldman Sachs is just above a potential support zone. So it could be ready to make a bounce here. But again, it's, right before earnings, so I would just stay away from it for now. But, it's the biggest holding in IAI, so I would watch it. U.S. Bank Corp reports in a couple days, so be careful there. But it's been in a very tight consolidation, so you have to watch for the direction of the break. A break to the upside would be bullish. Morgan Stanley reports in a couple days. They're one of the weaker ones. Again, Bank of America and JP Morgan look like the stronger ones to me. And finally, we have American Express, which is also one of the stronger ones because you can see there that it has maybe an ascending triangle. And of all of these, it's the closest to a 52-week high. And Visa and MasterCard are also strong, so I guess American Express fits in that category. Now this chart shows the healthcare SPDR on a weekly time frame as well. And again, another big advance from the low 60s to the low 90s. That's like a 50% advance from February 2016 to January 2018. A pretty sharp correction, but recovering and getting that little breakout there in May and one of the stronger sectors over the last 2 weeks or so. Now what's interesting is the biggest component, Johnson & Johnson, which is 11% or so, is the weakest. All right, but despite that, it's still one of the stronger sectors internally. We saw the new highs in the healthcare sector, and we look at the second biggest component, United Health. It's just a solid uptrend here. You had a little bit of a correction there into March, but a move to new highs here in July. So very strong on United Health. Both of them have earnings coming up tomorrow. Then when we look down the line, we get Pfizer, AbbVie, and Merck. And these three show some promise. First of all, you look at Pfizer, and it had this kind of triangle consolidation, and it's breaking out of it, and it reports at the end of the month. AbbVie took a really hard hit, but you can see support around 90, 88, and a test there and trying to turn up. So a good risk to reward ratio there for AbbVie, and it could turn up. And Merck, correcting here and then getting this breakout with the gap surge in early June. So it looks like it wants to challenge its 52-week highs. Then moving to Medtronic and Amgen and Abbott Labs, we can see that Medtronic is near or hit a 52-week high on that surge and breakout. So that is one of the stronger stocks. Had kind of this flag here. I've been following that one for quite a few weeks. And we look at Amgen. It's a very choppy uptrend, but it's still an uptrend and very close to a 52-week high. And then Abbott Labs has gone nowhere in 2018, but it could be an ascending triangle, and a breakout there would be bullish for Abbott. And finally, we have Gilead, which is a bit of a bottom pick, if you will, because you can see support in that 63, 68 area back in 2017, February, March, and we tested that level here in April, May, and maybe it's some sort of a rounding bottom. You had that sharp decline and then that big washout there, and it looks like we're recovering now. We're above the 40-month moving average. All right, so that concludes this edition of On Trend. Thanks very much.